you take a statistics class, so the expected return is actually is the mean. Okay, when you take that statistics, you will see the mean, which is mu, is actually that is your return. So remember, so we retrieve the data last time from the real world, right? So you just use the Excel, you have the average function, will get the mean immediately for the data return. For the risk is standard deviation. Okay, we use the small Greek letter delta to represent the risk associated with that return. So if you have the same level of return, so you wanted to have a lower level of risk, right? Or you have the same level of risk, you choose the security with a higher return. If two securities, their return and the risk are different, so calculate the coefficient of variation. Calculate the coefficient of variation. And that will give you the idea which stock or which security you're supposed to choose. Okay, what is coefficient of variation? Basically, coefficient of variation is the risk per unit of return. Okay, the risk per unit of return is that standard deviation divided by the mean. The standard deviation divided by the mean. So that one is called coefficient of variation. So the smaller, the better, right? The smaller, the better. So you wanted to compare two stocks to see which stock has lower coefficient of variation. Okay. Let's see, we have an example, okay? So the example is that the mean, which is the expected return, is the return, the possible value of that return times the probability of that value of return occurs, right? And this one, the sigma is you sum them up. So use that probability times the value, the possible value of that return, and then you sum them up. Okay. So let's see the example I have here. Okay. So this is the example. You can see the probability of that different economic for next time period. Okay, the probability 10% the economic downturn, 20% zero growth, 40% moderate growth, 30% high growth. When you sum those probability up, that's supposed to be 100%. Then you cover all the situation, right? You cover all the situation. You don't want it to have something is not covered. So the return 5%, negative 5%, 5%, 10%, or 20%, right? So your expected return, you just use the probability times that return and you sum them up. Okay, so let's see. We have the Excel spreadsheet. Okay, this is the state of economy, and you have the probability, and this is the return or the value of that probability. Okay, so the probability, remember, so is 0 0.1, 2, 0 0.4, 0 0.3. Okay, so look at the PowerPoint slide here. 10%, 20%, 40%, 30%, right? So the return, -5, 5, 10. Okay, so that's the return, right? So if you do, okay, let's say we do the probability type, the return. So the column B times the column C, okay? So you just use this one times the return. So that is this part, okay? We have the formula, the probability times the value, right? Okay, so once you get to the first one, you just apply that formula, right? So your expected return, okay, this is your expected return. Your expected return will be the sum of the product. Okay, so that is expected return. You can see it's 0.105, right? So if you change that to percent, okay, that is going to be 10.5. Okay, 10.5. Okay, that's exactly we got here. Okay. This is the way I show you how you get expected return. You just use the formula. In Excel, there is one function I suggest you to use is a sum product. Okay. Learn to use what is a sum product. So you have the sum product function, and then you don't have to do the calculation step by step. Okay. So use the sum product function and select all this and comma, and then you select next column, close parentheses. Okay. Learn how to use the sum product function, because this one, you're gonna use this one later, okay? Later on, we have the cost capital. You still need this sum product function, okay? Yeah, what? Huh? Yeah, okay. That's right. So we need to use the probability and the return. Okay. Yeah, thanks. Okay. So this one is we do the sum product function. Okay. The sum product function is easier for you. You don't have to do the step by step, and they will get you the result immediately. Okay. And make sure you just select the right row. So right column. Okay. So you have expected return. What are you gonna do for the standard deviation? Okay. So we're gonna talk about the standard deviation. Okay. So the standard deviation, you look at the standard deviation, is that it's going to be the square root of the sum of that value minus the mean. This is your mean, right? We just calculate, okay? And you square that, okay, times the probability, and you sum them up. So that one is a little bit complex, okay? So remember last time I told you, you just, you gotta return an Excel spreadsheet, use STDEV or STDVP, right? Use the standard deviation function, and you will get the delta immediately. But here, because it is different probability, okay, it's a different probability. It's not equally weighted. So the probability is different. So we're gonna do this, okay, in Excel as step by step. So for this standard deviation calculation with different probability, you do have to use Excel to do a calculation step by step. Okay, the first step, okay, remember we have expected return right here, right? First step, we call this one is called a deviation. Okay, what is the deviation? Deviation is your return minus the expected return. Okay, so you look, the return, this column is the number it keeps changing, but expected return is always 10.5. So I need you to put $sign to fix this expected return. Okay, when you do $sign for the cell you selected, so that number is fixed. Okay, it's not going to change. When you apply the same formula, it will be always 10.5. Okay, that's the deviation. Okay, so you can see, actually the first number is a -5 minus 10.5. This is 5 minus 10.5, right? So that is your deviation. And now we're gonna square that deviation. So the deviation squared is going to be the column E, and you squared, okay? So that is the formula here. So you can see this part, okay, the value minus the mean, and then you square, right? So that's this part. Okay, you square that. So basically the value minus the mean, we call this one as actually as a deviation, okay, deviation. So the square of that deviation is this number, you square that. Okay, so we have the squared deviation. Now we have, okay, now go back to it again. So after you square this part, okay, and then you can see you have to times the probability, right? I have to times the probability. So this is standard deviation times the probability. So probability is a column B, right? B times the column E squared. Because you already have the column E squared, and you just need the probability times the squared deviation, right? Okay, so that's basically that's the last column you see. And then you apply that formula. Okay, So this is the probability times the deviation squared. You're gonna do is that you just put sigma here. So it's like you sum them up, right? The sigma, that meaning the meaning for that sigma is you sum them up, okay? So you use the function is called sum, and then you get all those numbers, sum them up. Is this one your standard deviation? No, right? This is a called variance. Okay, this is the variance. Okay, you sum of those probability times squared deviation. That is called variance. So the variance, the difference between variance and the standard deviation is you take the square root, okay? You take the square root of the variance, that will be your standard deviation. So now we calculate the standard deviation, which is delta is equal to the square root, okay? The function we called as SQRT, square root. Okay, get the square root of the variance. Okay, this is your delta, which is the standard deviation. Okay, is 0.7566. Okay, let's see, right? Okay, 0.07566, right? So that's the delta. Okay, that's the delta or the risk. So how you get a risk? So you need to have this formula or the steps in your mind. Okay, there's no other way like one function and you can get everything down. Okay, have to do this, go step by step, and to keep this formula in your mind. Keep that formula in your mind. Okay, any questions about the risk and return? How you calculate the risk and how you get to the risk? How to get to the return, expected return? No? Okay, so yeah, so once you get the expected return in the standard deviation, and you can calculate the coefficient of variation, right? The coefficient of variation. Okay. So far, we talk about only one stock, okay? So you see, you have ExxonMobil, you have Walmart, you have Apple. So which one you need to choose? Okay, you have only one stock, okay? So you just choose one, okay? Just compare those three stocks, which one has lower coefficient of variation. Okay, that's very straightforward, right? Okay, so what is that? You know, you have a lot of money. Okay, you have more money. One stock is not enough. You know, I wanted to invest in 2 or more stocks. What about you want to invest in 2 or more stocks? Okay, that is the problem. Okay, it's not only one stock. So now you have to think about something else, right? So that one is called portfolio. So you make a portfolio. So the portfolio, that means at least 2 stocks in that package. You have to pick up 2 stocks. Okay, so why you have to choose 2 stock instead of 1? Or more stock instead of 1 stock? Why?
To mitigate risk from other stocks
Mm-hmm.
in order to make more money.
Okay. Good. So any ideas of why you wanted to make a portfolio instead of just pick up one stock?
It diversifies your portfolio, which
Mm-hmm.
basically the specific risk in one stock
Mm-hmm.
is canceled out in a sense by having another stock. So if one crashes, you don't have all your eggs in one basket.
Yeah, exactly. That's right. Okay. Yeah. So I like the idea is called, to put all your eggs in one basket, right? So the thing is that if you buy one stock is similar, you put all your eggs in one basket, right? So the benefits is that you diversify your asset, okay? Diversify. So when you lost in one stock, you might get a gain from another stock. You will not lose all of them, okay? So that's the idea, okay? The benefit of doing portfolio. So in reality, that's true, right? That's true. It's that if you invest in one stock and something happens, a lot of people think, okay, there may be Boeing company is good, okay? But you don't know, they have airplane crashed, someday crashed. Maybe you think, oh, United Airlines is good. You don't expect you have a coronavirus, okay? So every time you do the diversification, you will have the benefit, okay? Diversify your asset. You will not lose all of them. The risk could offset each other. Okay, especially we call the individual stock risk or form specific risk. Okay, this is the idea. So the form specific risk is through portfolio diversification, you can reduce. Okay, you can reduce the form specific risk, right? Form specific risk. And can you diversify through diversification to remove all the risk? No, right? It's still, when you buy stock, whatever, you buy one or two, three, you still experience the risk, okay? So the risk is still there. The only part is the form-specific risk you can reduce is the form-specific risk is not the market-related risk. Okay, that part of risk is still there, right? You can see on Monday is that because the stimulus check package was approved and stock market crash, the stock, all the IT stocks, they drop a lot. So that's the that's the market risk. So it affects all the stocks. Okay, you can see the bond yield increasing and all the stock price drops. So it's not only one stock. It doesn't matter you buy a two or three, or just one. Okay, so all the stock price drops a lot. So that is a market-related risk. So what is a market-related risk? Is the risk, is more broad, more macro, and affect the whole economy. Okay, that kind of risk you cannot diversify. Okay, so if you use a graph, is that so this part, the yellow part, or is a systematic risk or market risk. So your risk in that along that curve, you could drop or reduce until a certain level close to systematic risk, and that risk is stays there forever. Okay. This part only the drop is a firm specific risk. Okay, the firm specific risk starting to decrease as long as you have a portfolio And okay, empirically, if you have a 10 or 15 stock, so your market is fully diversified. Okay, so these are about like 20, most of the time it's just 10 or 15. So you reduced or those firm specific risk. So that will consider as the systematic risk affect your portfolio. Good, any idea? That's good. Yeah. Okay, so this is something and you talk about, for the investment, right? For the investment, you can see investment. If you buy, you buy stock on Monday and then you lose some of the stock, or 10%, or 6 or 5-6%, right? And if you bought stock yesterday, so you already got 20%. Just by Tesla, in one day you earn 20%. So that's a lot of stock, 20%. You're considering that, just one day you got 20%. So all money, right? So that's a huge risk and potential. Okay, and so different stock, also have a different risk, different type of risk. Okay, so that's the market-related risk, and that's kind of be replaced. You still are always there, market-related risk, and you can do portfolio diversification to reduce the firm-specific risk. Okay, so so how do you know the market risk? Because this is in general, right? The market. So basically, the market return, market risk, and what you can look is the index. Okay, the index of stocks, let's say SP 500. SP 500 is a stock market index including 500 stocks. Okay, the 500 stocks to represent the whole market, represent the market. And so in the United States, we have SP 500, okay, and the Dow Jones, right? And also you have a NASDAQ. Okay, those are the three major index on that in the US financial market. So you can see, let's see the file of Yahoo Finance. Okay. And when you see the Yahoo Finance, right? So you can see the SP 500, right? Dow Jones on NASDAQ, right? So the SP 500 is that 500 stocks, and Dow Jones only 30, and that's the NASDAQ and NASDAQ. Okay, so that's the three major indexes. For all other different countries, every country they have at least one major index to represent their market from around the world. Okay, so that's the market. So what we do is that we have a pretty good measure of your stock relative to the market. Is that regress the individual stock return on the market index return. Okay, on the market index return. So basically, and what you can do is just do the regression. Okay, you do regression, and then you estimate the beta. Okay, estimate the beta. Okay, so those are, what we can do is that, so let's say using Pepsi and the return on Pepsi and the return on SP 500. Okay, so the return on SP 500, that is your independent variable. Okay, and the return on Pepsi, that is your dependent variable. So once you have the independent variable and dependent variable, and then you just run regression, it will give you the coefficient of the SP 500. Okay, that's beta. Okay, so the beta is basically is the slope of that curve. Okay, what is the slope? Slope is the rise divided by run, right? So the rise divided by run, so that is the slope, is 1.1. So 1.1 is the beta. How do you know that? Okay, you can see you just use historical data return to calculate the beta. Okay, let's see. You can pick up any stock. Let's see. Okay, you do. Let's do Apple. Okay, so when you pick up Yahoo Finance, you can see you have a it was the, okay, yeah. So when you click on any stock, okay, they will tell you the beta. The 5 years monthly, 1.25. Okay, when you do that, you know, some of the time you can read open price, bid price, ask price, you know, days range. This is pretty, you know, straightforward, you understand, right? Okay, what does that mean? Do you know what is beta? We already talked about PE ratio, earnings per share, right? So all those might, you know, not confuse you. So can you tell me what the beta means? Why this is so important and they put on the first page? And when you read the stock beta, okay, this one, right? What can you conclude? What are the information tell you the beta, how you're gonna use it when you make a investment decision? Okay, so that's what I'm going to tell you, okay? Because you see, what is beta? Beta is the slope, right, of the return of that stock relative to the market. So that means when you see the beta is measuring the sensitivity of this stock relative to the general market. Okay, so if the slope is 1, that means, you know, it's like the SP 500, the return increased 1%, your stock return increased 1%, exactly the same. It's just a measure of this general stock market. That means beta equal to 1, right? The beta is 1.25 is when the SP 500 index, all the stock increase, on average, the return increase 1%, your stock return will be 1.25%. This beta is greater than 1. Okay, greater than 1. See, it's not 1, right? Greater than 1. That means is more sensitive, okay? So the general market return increased 1%. Your stock return will increase 1.25%. Okay. That's how you interpret beta. Let's say I give you another one. Maybe oil company. I say the oil company ExxonMobil. Okay. ExxonMobil 1.4. And let's say PME. That beta is negative. Negative 2.07. So what that means is when the market go up, they go down, right? So you, yeah.
1 minute ago, it was at like 300.
Uh-huh. Yeah. So what happens? They just crashed, right?
Already sold.
Oh, you already sold that?
Earlier, whenever it was at like
yeah, that's
almost 300.
This dropped 19%. You know, Tesla yesterday they increased 20%.
Yeah, I saw that.
Wow. That's see this GameStop is yeah, you know, you heard that story about the GameStop. Is pretty volatile. So yeah, so that's okay. You know, beta is 2, right? For Tesla. Beta is 2. That means, you know, is that when the market return increase 1%, Tesla they increase 2%. So the beta is usually the bigger the beta is, and the more sensitive. Okay, the more sensitive. Yeah, the more sensitive. So that's how you interpret beta. So what we can do is that we can estimate beta using Excel. Okay, so let's say you got the historical data. Okay, I think we did last time of the return for ExxonMobil, right? So we do that. Okay, now we just what do we do is just go to the SP500. We get SP500 and the historical data. Okay, so we got the historical price and apply for that. So where's the download button? So we supposed to, you know, download the SP500. Yeah. So where's the download button? Let me see. So once you have the historical data, you download the historical data, you calculate the daily return, and then you will be able to do the regression and to estimate the stock beta. Okay. So that is historical data, right? So when you apply, so they should have the data you download. You can download that. Okay, so let's say you have ExxonMobil last time we working on. So the first step, you get the data and adjust the price and the trading volume. And we don't need the trading volume. So you just get the return for ExxonMobil. So the return, it remembers, is the most recent adjusted price minus the previous adjusted price. Okay, adjusted price. And divided by the previous adjusted price. So that's the return. So you get the return for the ExxonMobil, right? ExxonMobil. So, and also you can get the return for S&P 500. So I just download this one. Okay, let's say this is the adjusted closing price for S&P 500. We do this one. Okay, that data might not be right. Okay, so we just get that, you know, as okay, S&P 500 return. So we just say that as S&P 500. We okay, is equal to the previous stock return minus previous and divided by the previous return. Okay, so that's the SP 500. Okay, SP 500. So and this is your stock. Okay, I say ExxonMobil, right? Control C and then paste numbers. Okay, now we have the return. This is the SP 500 on the left. That is your independent variable, which is going to be on the x-axis, and on the right is going to be your y-axis. Okay, you select the box column, and then you insert a scatter plot. Okay, let's say you have the scatter plot. So you will see it looks like that, right? That's your scatter plot. And then you can do is add trend line, or you can estimate so the return of these two. This is similar to what we have on the PowerPoint slides. And so once you have the line, and then you can estimate, okay? So all you just do is simplify. You can type as slope function. Okay, you type the function is called a slope. And this is your y, and this is your x. And y is your dependent variable. And this is your, okay, this is your independent variable. Okay. Okay, now you just close the parentheses. Use that slot function that will give you the beta. And that's the beta. So so the beta is basically you calculate the return of your stock and the return of SP500. This is not right. We just pick up some random number. So is that you actually need to get SP500, right? And then you can estimate the beta. Use the slot function, okay? Slot function. And that will similar to the one in the PowerPoint slide. You can estimate the line, actually. Okay, add a trend line. Okay, that's all for today. Yeah, have a good day.